MSTR has just taken one of the hardest hits in its entire history, a sell-off so violent that most people still haven't processed what's actually happening in the data under the surface. So in this video, we're diving deep into the relative price performance, momentum structure, capital rotation, and the key cost basis levels grounded in on-chain logic to map out what the upside targets could actually look like from here. So let's get straight into it. Today's going to be a huge update on MSTR because the last few weeks have been nothing short of savage for this stock, and the data finally gives us enough distance to dissect what's actually going on underneath the surface. First, let's talk about simple price performance measured in US dollars. Now, there's no way to sugarcoat this. It's been a pretty brutal month. We've dropped around 36% on a monthly change just alone, and that kind of move would annihilate most traditional equities and shake even the most experienced names out of the market. But context, as always, matters, because despite the severity of the monthly candle, we're still up over 22% on a year-on-year basis, which I bet would make most of you stop and question. But it's true. So when you zoom out and look at the bigger structure, this correction looks far less catastrophic than it feels day to day. But to really quantify the actual damage rather than rely on just our gut feeling, we can shift it over to the all-time high drawdown chart. Now this metric measures one thing and one thing only, the percentage decline from the previous peak in price. And this is powerful because it puts every correction into the same frame of reference, which is the prior all-time high. And what it shows us is the maximum current drawdown of this correction sits at around 63%. Now, 63% sounds extreme, which it is, but until you compare it to the reality of the previous cycle, during the depths of the last bear market, MSTR drew down roughly 89% from its previous all-time high, and it stayed in that region for a very long time. And that's the sort of collapse that only high beta assets that are tied to Bitcoin could ever experience. So when you see this recent 60-odd% correction, yes, it is significant, and it does sting a lot, but it's also very much within the normal volatility range for this asset. Anyone who's been around Bitcoin or MSTR or any Bitcoin leveraged equity has lived through far worse. It's violent, but it's not unfamiliar. But what is really interesting to me is the shape of the drawdown. The current structure actually mirrors the 2021 sell-off in May, the one that produced the infamous dead cat bounce before plunging into the brutal 2022 bear market. And that similarity could potentially make a lot of people nervous right now. But there's one key difference here for me. Bitcoin itself hasn't followed the same path this cycle, which brings us on to relative performance. Now, when you price MSTR in Bitcoin terms rather than dollars, the picture gets even more sobering. Even the yearly change is now sitting negatively at about minus 16% versus Bitcoin. So if you'd bought Bitcoin instead of MSTR about a year ago, you'd be around 16% better off in Bitcoin terms. And you might see this and conclude your analysis there. You see the red and assume that their strategy has failed. But relative performance is a dynamic metric, not a static one, and it's completely dependent on your starting point. And you can see this clearly on the relative performance ratio chart that compares the two assets over multiple timeframes. And what this chart makes painfully obvious is that even after this latest correction, if you'd bought MSTR at the cycle start point rather than Bitcoin, you would still be around 70% better off today. And during the peak in November of last year, that excess return was way over 370% in favor of MSTR. And that is an absurd amount of outperformance for any equity relative to Bitcoin, especially considering Bitcoin itself rallied over 6x during that exact same time frame. So yes, the metric is in the negative on the short-term view, but the broader takeaway is that MSTR still has been more profitable to hold through this entire cycle than simply holding Bitcoin alone. And that's an uncomfortable truth for people who get anchored to the most recent dip, but the long-term structure and the numbers just don't lie. Now, to move beyond performance and really understand the underlying health of the trend, we need to quantify momentum. And the best tool I've built for this is the momentum coalescence metric. Now, this indicator is designed to reveal when multiple separate layers of momentum are aligning behind a move. Instead of relying on one single reading, like just a MACD for example, it blends four completely independent components into a unified score. Now, the first component is a fast rate of change calculation on price, and the second is a slow rate of change, These let us compare pure directional strength instead of raw percentage change, which filters out the noise and focuses on trend acceleration versus deceleration. The third component is the volume delta engine, and this measures how much real volume is backing the moves, not just whether price is going up or down, but how committed the market is behind those moves. And the fourth component is the volatility directional bias. Instead of treating volatility as a single number, it breaks it down into upside volatility and downside volatility. And this is crucial because expanding volatility can mean two completely different things depending on which side it favours. If upside volatility expands, that's aggressive buying pressure. And if downside volatility expands, that's distribution. Now, once these four engines are blended and weighted into a single coalescence score, you get probably the most reliable snapshot of true momentum that I've found. And right now, that metric has printed the largest negative reading since the strategy began all the way back in August of 2020. Even worse than the deepest point of the previous bear market. And that tells you just how violent this latest sell-off has been under the hood. But here's where things start getting interesting for me. The structure appears to be now turning. The coalescence score is now curling up and beginning to form a bottom, and that means momentum is accelerating again from deeply oversold levels. And historically, that's only happened near durable cycle lows. And when you see all four engines starting to flip at the same time, it marks a kind of structural transition. Now, for people who prefer simpler metrics, the velocity RSI tells a similar story here, but from a different angle. And this is like an enhanced version of the classic relative strength index, except instead of just looking at the difference between up closes and down closes, it incorporates price velocity, which is essentially the speed at which recent highs and lows are moving. And what this does is capture those explosive moves and sharp reversals far more accurately than the traditional RSI. And on the daily chart, we can see here that we've just seen the second lowest reading ever on this indicator for MSTR. You simply don't see any readings like this unless you're deep into exhaustion territory. And the fact it's curling upwards, again, suggests that momentum is beginning to rebuild. And when you zoom it out onto the weekly time frame, the same pattern shows up. You can clearly see the early signs of a bottom forming as this indicator bends back upwards. But before we go any deeper, I want to quickly mention something, because a lot of people have been asking. Every one of these indicators I've been showing you today is part of my new charting platform that's launching, hopefully, by the end of this week. So, if you want to be notified as soon as it goes live, you can join my free newsletter, which I put a link to down in the description, and that's where I'll share the announcement of the launch first. Now, enough on momentum, let's talk about actual buyer behaviour. One of the strongest confirmations that a bottom may be forming is actually the traded volume. Now, traded volume is easy to understand because it simply measures how many shares are changing hands on a day-to-day basis. But the reason this matters a lot is that it has very distinct patterns in assets like MSTR. It either tends to spike either during euphoric peaks, which is when everyone is FOMO buying near the local top, or during durable bottoms, when buyers see value and step in aggressively. And what we're seeing right now is a clear uptick in traded shares, which has almost doubled the daily volume compared to what we were seeing just a couple of months ago, which is a meaningful shift in participation. And what's striking to me is that this surge in activity didn't just show up during the slide down, it appeared right at the bottom of the recent sell-off. And that to me tells you that buyers didn't capitulate any further, they stepped in aggressively and absorbed the supply at those levels. And when you see volume expand into a low, rather than evaporating as price falls, that's one of the most reliable signatures of real accumulation, the kind that often marks the early stages of a structural reversal rather than just a temporary bounce. And this is one I'm going to keep a very close eye on. So, if this truly was the bottom, the next question naturally becomes, what are the key levels that we need to reclaim now? And for that, we shift to the cost bands indicator. Now with Bitcoin, we can track the average short-term holder cost basis straight from the blockchain. And MSTR doesn't obviously have that luxury, but we can apply the same logic using a price-weighted volume distribution. And this here gives us an estimated average cost basis for the most recent investors, basically what the new money has likely paid for their shares. And right now, that level sits at around $325, meaning that If you'd bought MSTR within the past 5 or 6 months, this is your likely cost basis. And when you look at the cost bands, you can see that price has dropped into the second lowest band, which is a zone that has historically only been reached during the deepest bear markets. Price almost always gravitates back towards the average cost basis after falling through this level, but it usually doesn't go up in a straight line. So, if we recover from here, then there is a high probability that we chop around in the 212 to 260 cost band first, and that's the region above us, before attempting to reclaim the $325 average buyer level. Anyone who bought over the last 5 or 6 months is definitely sitting underwater right now, that's a fact, and the $325 level is where they finally get to break even, and that creates a sort of short-term magnetism on a chart, which we see in Bitcoin, altcoins, equities, basically anything with an active investor base. But when price finally does revisit that zone, it can do one or two things. Firstly, it can bounce straight off it as a sort of bear market resistance as the price drifts lower. Or secondly, it can often create the next leg higher, because the people who capitulated when it sold off because they thought MSTR was over end up buying back in at their original cost basis and pushing the price higher again. And for the majority of those that have held through this 40 to 60% drawdown, typically aren't selling at a break-even cost basis. They've just weathered through a brutal storm and expect a genuine return on their investment for their pain. So if the momentum metrics continue their upward trajectory by the time the price gets there, it can become a sort of launch pad towards the upper cost band levels. So to wrap things up, when you put all this together, the message is pretty clear. The recent drawdown has been really severe, especially in Bitcoin terms, but the underlying structure resembles a market that has just flushed out all the weak hands. Momentum indicators that have all bottomed simultaneously at historically low levels are now curling upward. The daily traded volume has doubled within recent months, and it's surged precisely where you'd expect real buyers to step in. And cost basis models show price sitting in a zone historically associated with durable cycle lows. Now, none of that guarantees an immediate reversal, but it does confirm that this move has the hallmarks of exhaustion and not controlled distribution. So from here, the story is all about reclaiming key bands and watching how price behaves as it approaches that low $200 region, and eventually back up towards the $325 average buyer level. Those will tell us whether this is just a violent reset or the start of an actual structural trend reversal. Or in other words, the damage was definitely real, but if momentum keeps strengthening as price recovers to those cost band zones, the path to higher targets opens up rather quickly.